Joining us to talk about the economy, what we should read into this data, Dr. Pronab Sen, veteran economist and chief statistician of the country. Dr. Sen, thanks so much for joining us. Dr. Sen, I want to get the technical part out of the way and then get into your analysis of the economy. So I think a lot of people, and including the government, seem to be pointing out that this year, when there is an expectation of improvement in the second half, and some high frequency data has suggested that the CSO's numbers are perhaps likely to be revised upwards, because these are based on essentially the first 2 quarters, or at least the first 7 months of data. Is that a fair assessment, sir?
Well, it is a fair assessment, but the question is, how much of an improvement are you talking about? Because what the CSO has done is that it has taken into account some improvement over the first 2 quarters. So, after that, it becomes sheer guesswork or wishful thinking, if you like.
Absolutely, Dr. Sen. So, I just wanted to get that technical out of the way. So let's take the numbers as they are, sir. It looks like from the annual numbers that we're in the third year of a slowdown, at least, on GDP growth basis. Is there anything you can glean from the data, Dr. Sen, which, provide some light on what started the slowdown? And then, of course, what exacerbated it is slightly easier to understand, because there is, GST and there is demonetization. But the start of the slowdown very clearly happened even before those events.
Yes, it did. Actually, the slowdown really starts with the slackening of rural demand. If you think about what happened post-2009, corporate India went into a bit of a slump, but the economy kept going because of the non-corporate sector. And a large chunk of it was essentially being driven by rural demand. And somewhere around 2012-13, rural demand started to flag, and it's continued to do so ever since. So it's now a trend, and it's something that the government really needs to look at very carefully. That here was rural demand which was growing faster than urban demand during the 2004 to 2012 period, now starting to slow down secularly over the last 5 years, and that's a serious issue.
Does that, since you started on the farm sector, sir, does that link into the MSP story, the pace of higher rise in MSP having slowed down? And then if it is partly linked to that, then you get into the debate about, what is appropriate, because you have inflation worries as well to deal with.
Well, yes, it has to do partly with the MSP story, but it also has to do with what's happening globally. Because globally, agricultural commodity prices softened quite sharply, and India is sensitive to that. So there are lots of bits and pieces that go into this weakening story. But that's only one part of it. The other part of it is that, remember, rural India is not just about agriculture. Agriculture is at its heart, but there's a lot more to it. In fact, now more than 55% of rural incomes really comes from non-agricultural activities. So one has to really look at the rural economy holistically, rather than looking at it essentially as a reflection of agriculture.
Point taken there, sir. But on the on farm sector, just one other question I had. So, if you look at the nominal numbers in this time's release, so they're expecting nominal growth at 2.8% for the farm sector compared to 9%. That, in effect, explains the kind of chatter around agrarian distress, because you have the price effect and you have the production effect together taken. Tells you why the farm sector is hurting, sir.
Yes, it is. And that's exactly correct. And this has now been happening, actually, if you really look at this period I'm talking about, which is post-2012-13, is that the farm prices have been seriously depressed. So the terms of trade are moving against agriculture, which means that even though we've had fairly poor agriculture because of droughts and because of demonetization, the price effect simply adds to those woes. And that's something quite serious.
So the policy correctives in that scenario are not easy to grasp, are they? But what do you do if you're looking to boost, for the want of a better word, the rural economy? One aspect, of course, is to provide jobs outside of agriculture. Do you have any thoughts, sir?
The thing is, as far as the rural economy is concerned, the jobs outside agriculture are actually pretty high. We have this, I think, mistaken belief that a farm family does only farming. That's not true. I mean, today, in an average farm family, probably 30 to 40% of their income comes from non-farm activities. So that's already there. But the thing is, it rides on agriculture. So agriculture, in a sense, provides the base. So you have to think of how do you prop up agriculture, and then along with it, how do you assist the non-agricultural rural activities from taking advantage of that agricultural prop.
Dr. Sen, I just want to switch focus to manufacturing as well. Again, what's your read on the manufacturing data? Is this a sort of pain point from the shift towards the from informal towards the formal? Is there more to it, sir, than that? Is it lack of success in initiatives like, say, Make in India, etc., just as an example, about the fact that for years now we have not been able to do anything to push domestic manufacturing?
Well, at the moment, what you're seeing in terms of the manufacturing data is essentially the organized sector data. And you're right, there has been a push away from the informal to the formal, which means that in a sense, the numbers that you're seeing today is reflecting a shift away from what we are not measuring. So when we actually get down to measuring the informal sector, the numbers are going to look a lot worse. And let's be very clear about this. Now, clearly, manufacturing is hurting. And I think partly it reflects the fact that rural demand, which was the real demand driver, that is weakening. But on the other hand, we've had the global economy, which is looking a lot better now and will continue to look better as we go forward. And we still haven't been able to take advantage of that. A lot of other countries have. I think a part of that has to do, again, with policy hiccups that have prevented Indian companies from taking advantage of what's happening in the global economy.
Does that link into the export-import data, sir, as well, that came in part of this release showing that imports are much higher this year than last year and export growth was flat?
Yeah, you see, what's happening there is it's really exports I'm talking about. As far as imports are concerned, what it's saying in effect is that Indian manufacturing is now facing much more competition from imports than it did earlier. And that is, I think, primarily a problem arising out of the strengthening of the rupee. But I was talking about the problem of exports, which is the source of demand for Indian products. We are not doing very well on that.
Would Dr. Sen, good morning.
About 4% of export growth is nothing.
Yeah.
Good morning.
Yeah, yes, it isn't. And that is what I was wanting to ask you. Do you think that this rising tide that everybody talks about, and which is the global GDP moving up, can actually take care of this? Or would India need some special impetus in terms of policy initiatives or otherwise to spur manufacturing back into place? As we speak, though, the manufacturing PMI has shown a bit of an uptick, but that's probably almost negligible.
No, look, PMI of 54 is actually pretty good. A lot of countries would be quite happy with that. But that's not the issue. The issue is that the global economy is looking up. And at precisely that time, we have a situation where the Indian manufacturing sector is unable to really expand its exports because of some of the complications that have come because of GST. How long it's going to take to sort this out, I don't know. But if it gets sorted out, we should be able to take advantage of it. We do know, again, from the 2004 to 2009 experience, that we are capable of expanding our exports by 20% plus. So the capability is there. What we do know from, again, the published data is that during this bad period between 2009 and now, Indian industries become a lot more efficient than it used to be. So theoretically, I think we should be in a better position to take advantage of the global conditions than earlier. But there are policy impediments which are coming in the way.
And the hypothesis, Dr. Sen, that the second half will be much stronger. I mean, the number is pegged at about 7% for H2 and arguably FY19 even better. Will this come in as a result of an uptick in manufacturing, or will this happen despite manufacturing being at the levels at best that it is at currently?
You know, the fact is that in any economy, at the heart of the economy are the production sectors, which is agriculture and manufacturing. As we've already discussed, agriculture isn't doing anything. In fact, it's doing fairly badly. So hopefully whatever uptick we're going to see next year will ride manufacturing, and that growth, as things stand today, will have to come from addressing the global market, because domestic demand in the initial phase is not going to do it for you.
Dr. Sen, just spinning this forward now, a lot of talk obviously about what you do to correct weakness in growth. And I have two questions in this regard. One is that, there was a recent Fitch report which talked about potential GDP growth of India being at about 6.7%. They're not the first to do it. I think there was an RBI paper a few months back which had also pegged potential growth between 6.7 to 6.9, if I have my numbers right. So compared to potential, are we really underperforming that much?
Well, a lot of these potential growth numbers are a little backward looking. These numbers are essentially emanating from an investment rate which is hanging around 28%. But remember, we've been in a situation where the investment rate has gone up to 38%. So if you really think about what we were talking about prior to 2009, we are talking about a potential growth rate for India upwards of 7.5%. Now, the belief that we cannot go back to that, I think, is completely misplaced. We can go back to that, and we really have to ask ourselves the question that what is it that has happened between then and now for the analysts to lower their estimate of potential growth rate. I mean, remember, potential growth rate is done through statistical devices rather than a structural understanding of the economy.
Is it investment, sir, then the contribution of investment to the economy? And if so, then is that the lever that, say, the budget or, other policies should be tackling?
Well, this is a question that I think economists have a hard time answering. Do investments lead the economy, or do investments follow other trends? My sense is you cannot boost investment by itself. It really needs to see the economy, particularly the demand side of the economy, growing, and investments will come on their own. And then it becomes a virtuous cycle. But I don't think you can try and kickstart investment except through public expenditure, which the government is already doing.
Absolutely. The other debate, sir, is on the real rates, and I think you alluded to that in the context of the export story. But where do you stand on the real rate story in the context of the investment story, sir?
Well, one needs to be very careful on this real rate issue. The interest rates don't change that much. What's been moving around is really the inflation rate. Now, the inflation rate is a derived variable. It comes out through the workings of the overall economy. And you can't be tinkering with the interest rates on a monthly basis just because inflation is moving in one direction or the other. It doesn't work that way, and it shouldn't work that way. So the question really is that whether the current interest rates in nominal terms are too high. Now, my sense is that on the average, the interest rates are just about right, but I believe that the yield curves are still too flat. Now, there are a lot of people who think otherwise, but my sense is the yield curve is too flat. We are actually encouraging automation and labor displacement.
It's steepened a bit, sir, but I know that could be temporary because there are fiscal fears, etc., that are getting built into the long end.
Yeah, it's been, but 7.4, yeah. Yeah.
All right.
It should be steeper than what we have now.
Fair enough. Dr. Sen, I have one last question, more statistical than current. So, if you look at the last few years, so first we had the new GDP series, then we had the new base of WPI, etc., getting built into the current GDP series, and now we're going to have a new base for GDP, most likely 2017-18. So, over a 10-year period, it's become very difficult, or has it become difficult to understand what's happening in the underlying economy, sir?
Not really. What does happen, if you really look at sectoral growth rates, the detailed breakdown, you do know what's happening to the underlying economy. The point is that when you then try to take that into account in the GDP series, you have to really rework your entire sample base. So the companies which were important 10 years ago are no longer important now, but you're continuing to get that data. So you have to rejig that. So it's really a balancing exercise rather than anything which is fundamental.
Fair enough. Dr. Sen, pleasure speaking to you. Thank you so much again for stopping by for this conversation. That's Dr. Pronab Sen and his analysis of the GDP numbers.